Welcome to the Development Journal. We are observing a significant shift in the industry as we move away from general-purpose computing toward a world of hyper-specialized silicon. This is not just about faster chips, but about hardware that is physically hardwired for efficiency and software agents that can fix production environments without any human help. We are starting today with the incredible performance of Taalas hardwired chips, which are now reaching 17,000 tokens per second, by moving inference directly into the silicon itself. It is a massive leap that challenges everything we know about the flexibility of traditional graphic processing units and the future of model deployment at scale. Beyond the hardware, we are seeing a new kind of intelligence emerging in multi-agent teams that collaborate to recover from system failures. These autonomous systems are beginning to handle complex development operations, tasks, and self-healing infrastructure, using the latest protocols like the Azure Model Context Protocol to manage production environments entirely on their own.
Sloan, the data behind those architectural shifts, suggests we are finally moving past the era of manual intervention in the cloud. I have been analyzing the performance data for these autonomous recovery teams, and while I have my doubts about total independence, the efficiency gains are quite startling. Let us dive into how hardwired silicon is changing things. When we look at the raw throughput, the Taalas HC1 chip is operating in a different universe by hitting 17,000 tokens per second on Llama 3.18 billion. Compare that to the roughly 150 tokens we get from an NVIDIA H100. It is a staggering jump in pure speed. This leap happens because they have essentially deleted the memory wall by physically wiring the model parameters directly into the metal layers of the silicon. By removing the need for expensive high-bandwidth memory, they have stripped away the primary bottleneck that slows down every other general-purpose graphics processing unit on the market today. What is even more surprising is their 8-week development cycle. Usually, creating an application-specific integrated circuit takes 2 years of painstaking work. They are bypassing that timeline by focusing their manufacturing changes strictly on the top metal masks, which allows for a radical acceleration in how quickly we can produce these specialized chips. However, we must confront the reality that this efficiency comes at the cost of total inflexibility. If the underlying model architecture changes, these chips become expensive paperweights because the logic is literally hardwired into the metal. Sloan, does the business world really have the stomach for hardware that cannot be repurposed when the next big algorithm drops?
That risk is certainly real, but the immediate economic incentive is hard to ignore for enterprise data centers. We are seeing racks that can house 10 separate 250-watt cards, providing the throughput of an entire cluster. Because they run so efficiently, they only require standard air cooling instead of complex liquid systems. When you factor in a 1,000 times improvement in performance per watt and performance per dollar, the trade-off for flexibility looks like a bargain. Companies need to lower operational costs, and moving away from the massive overhead of traditional instruction sets is the most direct path to achieving that sustainable scale. This technology also opens the door for true device-native artificial intelligence in our smartphones and industrial sensors. Imagine having zero-latency local inference that does not rely on a cloud connection. It transforms the user experience from a slow back and forth with a server into an instantaneous interaction that happens entirely on the local hardware. As we move from these incredible physical speeds in the silicon, we have to look at how that power is being utilized. It is one thing to have fast chips, but the real magic happens when we shift from the physical speed of the silicon to the cognitive speed of the autonomous agents running on top of it. On February 21st, 2026, a researcher named Evangelos Letsos witnessed something quite profound at Andromeda Field Research. A back-end artificial intelligence agent stepped in to autonomously patch a configuration error made by its front-end teammate. This was not just a simple fix, but a display of true cross-vendor interoperability between different models. The system had hit a wall with a bad request error stating the requested model was not supported. Instead of crashing, the agent searched the repository and updated the model identifiers itself. Seeing these heterogeneous agents from different vendors collaborate to fix a broken workflow suggests that the silos we have built around these models are finally beginning to crumble. What really changes the business landscape is how the agent handled the aftermath of the repair. It did not just stop at the fix. It generated a full automated incident report that included a cause analysis. It even went as far as recommending new continuous integration checks to ensure this specific configuration failure would never happen again in the future. This level of autonomy suggests we are moving toward a world where software can effectively maintain itself without a human developer constantly monitoring the console. Vance, when you analyze how these agents verify their work, does the mechanical reality of this discovery match the polished story we are hearing?
The mechanical reality behind that recovery is a process called sequential context propagation. For the second agent to succeed, it had to ingest the entire error output of the first agent as a diagnostic input. This requires massive amounts of data to be passed back and forth between different artificial intelligence systems with millisecond latency via specialized tool calls. We also cannot overlook the fact that a third agent was necessary to keep the whole operation from spiraling out of control. This entity, acting as a data engineer, had to conduct a rigorous peer review integrity check. It validated the fix before the team could proceed. Without that check, we are just letting autonomous agents commit unverified code. While the Andromeda Field Research Faction software makes these updates look seamless, it is still a very controlled environment. The success of a cross-vendor team depends entirely on the accuracy of those millisecond latency tool calls scanning local files. If the repository structure is messy, the diagnostic remediation process could easily introduce more bugs than it actually solves. We are clearly moving from experimental multi-agent research towards something more permanent and sturdy in the corporate world. The real test is whether these self-healing capabilities can survive the transition into enterprise-grade autonomous development operations. Implementing these agentic artificial intelligence frameworks within a massive infrastructure like the Microsoft Cloud Platform is the next logical step.
Hector Flores has just demonstrated a self-healing environment where agentic artificial intelligence successfully detects and resolves 70% of production incidents without any human intervention. This empirical evidence validates the recent Gartner research predicting that by 2025, 30% of organizations will use these automated tools to reduce incident response times by up to 90%. The sophisticated part of this evolution is the Model Context Protocol. It allows advanced agents like Claude Code and GitHub Copilot to treat live Microsoft Azure infrastructure as a queryable context for reasoning. Instead of relying on static documentation, these systems read the current state of the cloud to make informed decisions about how to fix a failing service. By transitioning traditional runbooks into structured markdown formats with executable commands, companies are finally bridging the gap between human knowledge and machine execution. This enables autonomous validation and deep-root cause analysis that goes far beyond a simple reboot. It represents a fundamental shift in how we think about maintaining complex digital systems at a global enterprise scale. Even with these impressive resolution rates, I find myself wondering about the safety nets required when we give code the keys to the kingdom. Vance, does the underlying architecture provide enough friction to ensure these autonomous agents do not accidentally delete an entire production database while trying to be helpful during a minor service outage?
That concern is why the implementation of graduated privilege tiers is the most critical part of this framework. By restricting destructive actions like resource deletion to human-approved workflows, engineers can safely deploy these agents. Tier 1 through 3 levels ensure the artificial intelligence can restart a service, but cannot wipe a subnet without a senior developer authorizing the action. We are moving away from traditional fire and forget automation scripts toward true agentic feedback loops. These loops utilize real-time state checks and verification steps to differentiate a successful resolution from a failed attempt. It is a much more rigorous engineering approach than simply running a bash script and hoping for the best when a server starts reporting errors. The technical win here is using application insights telemetry to trigger GitHub Copilot agents for specific tasks like real-time database connection pool resets. When telemetry shows a spike in latent connections, the agent investigates the logs and applies the fix immediately. This level of granularity ensures that the system recovers before the end users even notice a performance dip. While the speed of these self-healing systems is breathtaking, not every part of the technology sector is moving at such a frantic pace. We need to pivot from the breakneck speed of autonomous tech to the steady, sideways momentum of the world's largest tech company. Let us look at why Apple is facing a neutral 21-day outlook. The shift from autonomous code to the financial inertia of the world's largest consumer electronics company is stark. Apple is currently sitting on a massive $3.91 trillion market capitalization, but the technical indicators suggest a period of absolute stasis. There is a 21-day sideways trend that feels remarkably stagnant right now. With a relative strength index of 46.69, there is zero momentum to push the price past the current $266.18 mark. The news sentiment is currently 100% neutral, which means there are no immediate catalysts to excite traders or break this current consolidation pattern in the short term. I am particularly focused on the current ratio of 0.89, which signals some potential tightness in short-term liquidity for the Cupertino giant. While the operating margin remains impressive at 31.97%, that low current ratio is a legitimate flag that cannot be ignored when evaluating their immediate financial health. The wait for a meaningful shift might be longer than many expect since the next major earnings report is scheduled for April 29, 2026. It leaves investors staring at a massive window of sideways trading. But Sloan, I wonder if the sheer scale of their underlying business model outweighs these technical frictions.
The business fundamentals tell a story of incredible strength that technical charts often overlook during quiet periods. A return on equity of 152% shows a company operating at peak efficiency despite the lack of price movement. Even if the stock is idling, the underlying business is generating wealth at an almost unprecedented scale for its shareholders. While you highlighted the liquidity ratio, we must account for the $98.77 billion in free cash flow they generate annually. That massive cushion essentially negates short-term liquidity concerns because their ability to produce cash is so consistent. It is a financial fortress that allows them to weather any temporary periods of market indifference. The 19.50% year-over-year earnings growth supports the bullish consensus on Wall Street. With an average price target of $293.07, analysts clearly believe the current revenue growth is just a baseline. The long-term trajectory remains robust despite the lack of current movement. This period of consolidation reflects a broader shift towards specialized efficiency in both silicon and
Whether we are talking about Taalas pushing 17,000 tokens per second through hardwired logic or multi-agent artificial intelligence systems fixing their own code in production, the engineering focus has shifted. We are no longer chasing general flexibility when we can hardwire specialized performance directly into the silicon or the software architecture itself.
Those specific examples reveal how the future belongs to hyper-specialized systems. By moving away from general-purpose overhead and toward autonomous self-healing agents, Companies are essentially building immune systems for their digital infrastructure. It is a massive pivot from human oversight toward machines that operate with both extreme speed and total independence. Thank you for joining us as we navigate these deep architectural shifts and the financial realities behind them. As silicon becomes more rigid and software becomes more fluid, the boundary between the two continues to blur in fascinating ways. We will be back tomorrow to explore what comes next. I am Sloan, and this is the Developer Journal.